I don't want the state to take my house to pay for my long-term nursing home stay. I don't want to get kicked out of my own home and lose my assets. This is a question I get all the time from clients, concerned that they will lose everything if they or their spouse need full-time nursing home care as they age. Well, an asset protection trust may be a solution. However, this question does not warrant a simple yes or no answer. Trusts are very complicated, with every family's needs and circumstances unique to them. So today I have a special guest, estate planning attorney Patricia Shevy, to help us better understand the complications of asset protection trusts in New York State. Welcome back to The Retirement Fix, a monthly podcast offering strategies for less stress and more success in your go-go retirement years. I'm your host, John Gigliello, a certified financial planner with the Albany Financial Group, and I'm here to be your guide to keeping more of your hard-earned money by making smart financial decisions in retirement. This podcast is for people nearing or in retirement who want to learn more about proactive tax planning, retirement income planning, Social Security timing, investment management, and asset protection. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Joining us today is Patricia Shevy, the founder of the Shevy Law Firm of Albany, New York. Tricia focuses her practice exclusively in the areas of estate planning and administration, elder law special needs planning, and business succession planning. She is an active member of the New York State Bar Association's Trust and Estates Law Section, immediate past chair, and Elder Law and Special Needs Section, former co-editor of the Elder and Special Needs Law Journal. Tricia is also the chair of the association's Continuing Legal Education Committee. She's a member of the Albany County Bar Association and the American College of Trust and Estate Counsel. Tricia was honored by the New York State Board of Law Examiners with the opportunity to teach all attorneys applying for admission to practice the basics of powers of attorney, healthcare proxies, and trusts. She also regularly lectures and writes for continuing legal education programs offered by the New York State Bar Association. Patricia, welcome, and thanks for being on the show today.
Thank you for having me.
Yeah. I just read through your list of accomplishments, and boy, that's quite impressive. You've been practicing for how long now?
So I've been practicing for 28 years.
28 years. Wow. Okay.
Long 28
A
years.
long 28 years. Yeah, a lot of valuable experience there. I'm sure you've seen a lot. Um, Let me ask you a question. Why did you choose to? So there's many different areas that, attorneys can practice and specialize in. Why did you choose the estate planning elder law direction?
Sure. So when I was in college, I was a finance major, just in case I did not like the practice of law. I wanted to be able to still get a job.
Mm,
And so when I was in law school, I thought I was going to be an environmental law attorney. And
mm,
that was just not for me. I took one class and realized it was, to me, it was boring. So then I had taken a trust and estates class and a property class, and I thought this is stuff that I like. And by doing trust and estates and elder law, I still get to use some of that finance training that I got
mhm,
when I was in college.
mhm.
So most people think that lawyers and numbers don't match, but when you're doing trust and estates and elder law, you really need to be able to understand the numbers.
Sure. Oh, very important. Yeah. And that makes a lot of sense. And doing the work that you do, doing the work that I do, you're helping people, right? You're helping people with complex issues, and it's a way to give back. So
Yep.
good for
Yep.
you.
We do, both of us, we talk to people about things that they don't want to talk about. People do not want to talk about the fact that at some point they won't be with us anymore. So you and I both have to be able to have those types of discussions.
That's correct. Absolutely correct. So again, a fascinating topic, and again, a lot of questions on this. So let's dive right in. Let's get to these questions.
Great.
First one is, can you just give us a general overview? What's the process of asset protection planning in New York State? And we'll keep obviously, you practice in New York State. We'll keep everything that you say today in terms of New York State law.
Perfect. So it would take me about 3 hours to go through all of it with you. So I'm going to give you the basics of what the rules are. So asset protection planning, from my perspective, is protecting your assets from potential long-term care expenses. So that's what I'm going to talk about. If one person, an individual, needs to go into a nursing home, they're allowed to have $32,396 to qualify for Medicaid, to pay the nursing home. If they have more than that, then they are expected to spend down until they get down to that $32,396 before Medicaid will pay. Many times we're planning with married couples where the one who's going into the nursing home, the spouse going into the nursing home, gets to keep that $32,396, and the spouse, called a community spouse, gets to keep more than that. That spouse gets to keep the couple's home, and it can be valued at up to $1,097,000. That spouse in the community gets to keep personal things and a car and one of two numbers. And this is where a lot of people get confused. Generally, the community spouse gets to keep about $75,000. So $74,820 is the exact number. The community spouse could keep more if the couple paid for some nursing home services. So if the couple pays $157,920 to a nursing home, then the community spouse can keep up to $157,920. So someone may come into you and say, hey, I heard somewhere that I can keep 150 grand. And I have to say, well, no, you can't keep 150 grand unless you spent 150 grand. So people get confused with that. And then what we do is we help people look at those rules and see what they have in assets, and then decide what can we do to protect what you have that is over those numbers. All right. Mm-hmm. The other thing is, and we'll talk about it in a few questions, I think, is retirement accounts. Mm-hmm. Retirement accounts in payout, meaning the person is taking the required distribution. So when you're 73, you have to start taking your required distributions. Once you're taking those required distributions, the balance in the IRA is no longer considered an available asset for the nursing home. Mm. The RMD, the money that you're taking out, is considered income, and you have to contribute your income toward the cost of care. But you don't have to dip into the overall balance of the IRA to pay the nursing home.
So in essence, the principal is protected. We'll call it that. And the income is open, right?
Essentially. Yeah. What people need to remember, though, is when you have an IRA, you really need to make sure that your beneficiary designations are current, that you have a primary and a contingent. That way, when the person dies, the money's going to the beneficiary. That IRA is going to the beneficiary. If there is no beneficiary, or the person has written my estate as the beneficiary on an IRA, and they've been in a nursing home and been on Medicaid, well, now it's going to go through your probate estate, and the first person getting paid out of that IRA is the state, to reimburse the state for the services that were provided to you under Medicaid. So it's really important. Most of the people I talk with have a house and some savings and a lot in retirement. So we need to make sure that they understand that the IRA, the 401k, the deferred comp, the 403b, whatever they have, that they have good beneficiary designations in place.
Wow. Okay. So I can certainly see how your background in finance would help you through all this. There are a lot of numbers there. But I'm already thinking about a future episode, we could probably spend a whole show talking about beneficiary designations and the pros and cons of naming certain family members and not naming minors and things of that nature. Yeah, yeah.
I would
So
be happy to do that with you.
yeah, that's good. I'll make a note of that for sure. Okay, so mentioned a lot there. The dollar figures, what folks can't keep. I mentioned in the intro a big fear, and you actually hear it in the media and read it in the media sometimes. People are worried about getting kicked out of their homes. And if the husband goes in a nursing home and the spouse is still living in the home, oh my God, I don't want my spouse to get kicked out, which would not happen, right? They can't kick the spouse out of her
Correct.
domicile, right? To pay
Correct.
for, yeah,
Yeah, the
okay,
community spouse is allowed to keep a house valued at up to $1,097,000.
right.
And that number is adjusted annually. So that 1,097,000 is this year's number. In January, the Department of Health will likely bump it a little bit. But
Mhm.
when you're living in the house, as long as you're living in the house, they can't put a lien on it. It's protected for the community spouse.
Okay, good to know. So you mentioned quite a few assets that can go into that type of asset protection trust. Is there anything more to speak about in that area, Trish, as far as the different types of assets? Maybe the home, it seems like the primary residence is the big asset going into this type of
Correct.
trust, right?
So we do not put retirement accounts into the trust. If you tried to put a retirement account into the trust, you're paying immediate income taxation on the whole thing. Okay.
Mm.
So that's off the table. We've talked a little bit about that.
Because,
If
excuse me
you,
1 second, would that
yeah,
be considered, it's considered a distribution to a new owner in essence?
correct.
Yeah, okay.
Yeah. So
Okay,
yeah,
good
you don't want
point.
to do
Mhm.
that.
Okay,
So let's talk a little bit about the trust first before I tell you what to put into it.
sure, please. Mhm.
So the Medicaid trust is an irrevocable trust that people can use to protect assets from the nursing home. In order for it to work, the assets need to be retitled and be in the name of the trust for at least 5 years before a nursing home admission. Let's say that we're putting the house into the trust. You put the house into the trust, nobody can kick you out. I hear people come in and say, well, I'm just going to put my son on the deed. And I'll explain to them it's not a good idea because, as John just mentioned, he can kick you out. So we don't want to do that. And there are other tax reasons to not put the house in your kid's name. You'll lose your star exemption. And you put your house in your kid's name, when they sell it, they're going to pay capital gains tax. So what we do instead is we take the house and we put it in that irrevocable Medicaid Asset Protection Trust. You still get to live there. Nobody can kick you out. You still get your star exemption. And if you're getting an enhanced senior exemption, you still get that. And then if the house is still in the trust when you die, the kids will get what's called a step up in basis, meaning that the kids' cost, and the beneficiaries, it might not be a kid, but
Right.
your kid, your beneficiary's cost is the fair market value of the property on the day you die. So that if they sell it soon after you've passed, they're not paying any capital gains tax. So the rules of the trust, you put the deed into the trust. Nothing really changes while you're living. You're still paying the expenses. It's still your house. The way that we let the person putting their house into the trust, the grantor, keep control, because remember, it's an irrevocable trust, is the person has the power to change the trustee, and that person has the power to change the beneficiaries. So you still have control. You just have to go through steps to exercise that control. Other assets that can go into the Medicaid trust. So non-qualified investments. All right. So not retirement accounts. Non-qualified investments can go into the trust. The way that we draft our Medicaid trusts is that the income, the interest and dividends, and rent, if there's rental properties, the income must be distributed to the grantor. All right.
Mhm.
And then the principal can't be touched by the grantor, because if the principal can be touched by the grantor, it can be touched by the nursing home. So the grantor must take the income out of the trust. So if we put some investments inside the trust, then the grantor must receive the interest and dividends at least annually. I like to set it up with my clients so that they get it quarterly, so that it's not one big check at the end of the year or at the beginning of the next year. It's a guaranteed stream of income quarterly.
Taxable to them, correct? As grantors?
Correct. The good thing about the Medicaid Asset Protection Trust is since we're pushing the income out to the grantor is paying the tax at the grantor's rate, not at a trust income tax rate.
Okay, good. Yeah, you mentioned the step up in basis. That's so big in tax planning, right? Proactive tax planning,
Correct.
trying to preserve that. Yeah.
Yeah. And unfortunately, there's a lot of misinformation out there. A few years ago, it is Revenue Ruling 2023-2. There was the IRS said that irrevocable trusts don't get a step up in basis. So everybody was like panicking and thinking, oh, I have this Medicaid trust. My kids aren't going to get the step up in basis. That revenue ruling was really dealing with people who are doing estate tax planning, all right, trying to avoid the estate tax. Most people who are doing Medicaid asset protection trusts don't have taxable estates.
Right.
So the way that we draft the Medicaid trust is by letting the grantor keep that power to change the beneficiaries. The transfer into the trust is not a completed gift. All right. So it's not a completed gift. So therefore, it is includable in the grantor's taxable estate. And again, the people who are doing this don't usually have a taxable estate. Since it's includable in the grantor's taxable estate, the kids get the step up on basis through the Medicaid trust.
Right. Okay.
That was complicated, I know. If it's drafted properly, the Medicaid trust still gets the step up in basis.
No, so valuable there. And along the lines, very quickly, till we'll move to the next question. I've read and heard about instances where, and let me know how often you see this, but you can have a bulletproof trust, right? You've got everything covered, but unless the clients actually transfer title, right, and put the asset and retitle the asset, it's no good, right?
Absolutely. So I have also seen that. So when I meet with clients, I try to go through with them what they should put in the trust and then tell them what to do. So we'll file the deed into the trust, and then I'll say, go to your financial advisor and open a trust account. And then my suggestion is that you move these 3 accounts into the trust, knowing that once they're in the trust, you have to take the income out. So you have to take out the interest and dividends. You can no longer let them be reinvested. Capital gains are not income for purposes of a Medicaid trust. Capital gains can stay inside the trust. But we tell them you really need to do it, because if you don't move the assets into the trust, you're not starting your 5-year look back period.
Right. Okay. As far as creditor protection, Tricia, you've alluded to some of these before, but what do you see as the biggest threat to a person's assets, as far as, we talked about nursing home care, any other areas that may threaten a person's assets out there where you might use a trust to mitigate that?
Sure. So a whole nother episode would be talking about estate tax and how to avoid that or minimize that. Other things to worry about are creditors and predators. So you're driving down the street and you hit somebody and you're at fault. Well, that person's going to sue you and come after your assets. Years ago, I had a potential client come in and say, I know about all these potential lawsuits. I'm going to get sued. Can I put all my money into a Medicaid trust? And I said, no, because you're doing it to defraud your creditors. So if you know that you have potential liability coming down the road, the trust is not going to protect you, because the debtor-creditor law in New York will say you did it to avoid your creditors, it's voidable. However, if you're planning as part of your estate and you don't have creditors looming or a lawsuit looming, you can put your assets into the Medicaid Asset Protection Trust. And as long as you weren't trying to defraud your creditors, the assets inside the trust would be protected when I'm driving down the street and I hit somebody and I'm at fault, because I don't own the assets that are in the trust anymore.
Sure. Okay, makes sense. And another episode popped into my mind as far as protecting assets. Again, in your scenario, you're driving down the road, you get hit by somebody. When we talk about asset protection in the financial planning world, we're thinking about lawsuits, basically. And to use an extreme example, you're driving down the road and you hit, and you're negligible, and you hit a plastic surgeon, right? They're going to sue you for $40 million because they can't do what they do anymore. So we typically have a conversation about additional umbrella liability insurance policies, things of that nature. But there sounds like this is another podcast here, another subject to talk about in the future. So, okay,
Sounds
good.
good.
Very, very good. Now, just generally speaking about trusts in general, you mentioned irrevocable, and can you pronounce it either way?
You
Irrevocable,
can. It's yeah,
irrevocable.
irrevocable, irrevocable,
Okay,
tomato,
okay,
tomato, whatever you want it
okay,
to be.
okay. Can you just tell our listeners briefly the differences between an irrevocable trust and a revocable trust?
Sure, sure. So a revocable trust or a revocable trust is used to avoid probate. And John, as you mentioned, like you've seen people not do what they're supposed to do. The whole point of the revocable trust is to avoid probate. I can't tell you how many people bought a binder, went to a dinner and paid a lot of money to a lawyer, got a revocable trust binder, and then never put the assets into the revocable trust. All right. So, in order for a revocable trust to avoid probate, the assets either need to be retitled in the trust or have the trust or people designated as beneficiaries. Where we live, the Capital District, Albany County, Rensselaer County, Schenectady County, Saratoga County, Greene, Columbia, those are all really well-run courts.
Mhm.
I don't typically recommend that people put everything in a revocable trust to avoid probate in those courts if it's a traditional situation. Everything's going to the surviving spouse and then to the kids because our courts are really good and they're really fast. And you're going to forget to put something in your revocable trust, and I'm going to end up probating your will anyway. Okay.
Right.
If you have real estate outside of New York State, then I'm definitely going to recommend a revocable trust so that we don't need to probate your will in 2 states. If you live below the Tappan Zee Cuomo Bridge, okay, if you live in the bottom part of the state, I'm completely going to tell you to use a revocable trust because their courts are overwhelmed and it could take you 6 months to a year to get the will through probate. So my clients that live closer to New York City or in New York City, I push the revocable trust and I really push them to make sure that they put their assets into the revocable trust and have good beneficiary designations to avoid the probate process there. Irrevocable trusts. Most of the irrevocable trusts that I write are Medicaid asset protection trusts, trusts that we want to use to try and protect the assets from nursing home costs. Now, those trusts are irrevocable, but nothing in New York is ever really irrevocable. Okay.
I
in
hear
New
that,
York,
right.
Yep. You can draft the Medicaid Asset Protection Trust so that the only beneficiaries of the trust while you are living are competent adults. And as long as the beneficiaries are competent adults, the grantor has the power to change or terminate the trust with the prior written consent of those competent adult beneficiaries. So there's a law that says if your beneficiaries are competent adults, they can consent to a change or a revocation in that irrevocable trust. So while they're irrevocable, they're really not, as long as it's drafted properly. And I can tell you that I've seen lots of improperly drafted trusts where I've looked at it and I said, you didn't keep the power to change the beneficiaries. So that's a problem. And now we can't use, and you have minors or potential minors or disabled beneficiaries. I can't use that law in order to change your trust. It can get complicated.
Yeah, it sure does. So that transfers of ownership, it sounds like giving up control and the irrevocability of that transaction is key, is important.
It
Right?
absolutely is, because
Yeah.
I should have said a revocable trust does nothing to protect your assets from the nursing home. It needs to be irrevocable in order to protect your assets from the nursing home.
That's right. Okay. Good point. Very important point to be made. Okay. Can you talk a little bit about any of the potential tax consequences associated with these asset protection trust structures here in New York State? You've mentioned a couple already about the grantor right, being taxable on the distributions they receive. But anything, again, that we should be aware of from a
So
tax
a few
consequence?
things.
Yeah.
So the first is that if it's drafted properly and it's a grantor trust, the creator of the trust, the grantor, is the person that's going to pay the income tax on the interest and dividends, the income. It's also going to be drafted so that for real property tax purposes, the grantor is still responsible for those expenses. When you put your house in the trust, okay, as long as you've lived in your house for at least 2 out of the last 5 years, if the house is sold while you're living, a single person gets up to $250,000 of capital gains exclusion. Married couple gets 500. So by putting the house in the trust, you even still get that. You're not giving that up. Okay. You're still going to get your 250 or 500 of exclusion. Where people make a mistake is when they do a life estate deed, where they say, I don't want to do a trust. I'm going to keep the life use in my property, and then my kids get it by deed when I die. The problem is if that house is sold while you're living and you used a life estate deed, you get a portion of the proceeds based on how old you are, and there's a whole formula for that. You don't pay tax on your part. You don't pay capital gains tax on your part as long as you lived in the house for at least 2 out of the last 5 years. Your kids, your beneficiaries are going to get the rest, and they're not going to get that capital gains exclusion. So they're going to pay capital gains tax. So that's a big difference between the use of a Medicaid trust and the use of a life estate deed, which is why I don't do life estate deeds. I haven't done one in almost 20 years. I just don't do them anymore because of that potential risk. And clients will say, we're never going to sell my house. And I'll be like, you say that today when you have to get through one winter of shoveling the snow at an empty house, you're going to sell it.
Right.
So back to taxes. So the grantor is paying the taxes at the grantor's rate, which is good. The house in the trust, it's sold while you're living. You're not paying capital gains tax if your gain is less than the 250 or the 500. And we've talked about this a little bit. You wait until after the grantor has died and the beneficiaries get that step up in basis. Their cost is the fair market value of the property on the day of death.
Okay.
But those are the biggies.
Right.
Capital gains tax. So the capital gains tax is still, while it's in the trust, that is still the expense of the grantor outside the trust.
Outside, right. Okay. Having said all of that, Tricia, the tax rates, the marginal tax rates for trusts, right, are considerably higher for individuals. Isn't that
correct?
Right?
So once you hit about $14,000 of income inside a trust, if it's not distributed, it's going to be taxed at the almost 40% rate.
Yeah. Wow.
So we don't want that. We want the income distributed to the grantor, and then the grantor pays the tax on it at the grantor's personal rate.
All right, good to know. We've already discussed and you've expanded on, why you don't want to put an IRA or retirement asset into a trust, but just IRAs on their own, they do offer, I would think, certain protections on their own, right? Without even having considered putting them in a trust or not. Right? Creditor protection, things like that.
Creditor protection for sure.
Yeah.
But for nursing home purposes, the big deal is that if you're taking your required distributions, you're 73, you're taking your required distributions, they cannot force you to spend the balance that's in the account. They can only make you spend the RMD.
Right.
The only issue is when, maybe there's an age difference in spouses, and one is in the nursing home. Let's say he's 75 and he's in the nursing home and he's taking his RMDs, and she's 55 and still working. Problem is, she's not even 59. In my example, she's not even 59 yet. So whatever she takes out, she's going to have to pay a 10% penalty.
Right.
But when you are applying for Medicaid, a married couple is looked at as one unit. So if she's not taking distributions from her IRA, then it's considered an available asset. And I don't like to recommend divorce to people for Medicaid planning purposes, but in a situation like that, I might say, unless you want to count your IRA, you're not even retired yet, you want to count your IRA as an available asset, you might need to consider a divorce in that type of a situation.
Sure, good point.
And I don't do divorces.
Yeah, don't do divorce. Get your hands full with everything else here. Okay. One follow-up question on the RMD. So you mentioned the RMD, whether it's 73 or 75 for some folks. What happens if somebody, sometimes folks need the cash flow, so they don't wait till their RMDs. They're pulling on their nest egg assets, at age 65 or way before that. Does that set any type of precedent as far as the rules are concerned later if they do need nursing home care? They've already started taking,
Not
you know,
really.
not
So
really.
when you
Okay.
go into the nursing home, you can reduce it down to the RMDs. But what you need to realize is that when you are submitting your application for Medicaid, the income that they're looking at is going to be based on your prior year tax return. So if you know that a nursing home admission is coming and you can do some planning, you go back to your RMD for the year before the nursing home admission.
All right, good. Thanks for clarifying that. Again, getting through a lot of information here, all very valuable. So in the remaining couple minutes that we have left here, Trish, just a couple more questions for
Sure.
you. So as far as you and your practice is concerned, what's your general approach to handling these complex estate asset protection issues and implementing these strategies? Give us an overview of how you plan for this with
Sure.
clients.
So what we do first is when someone calls to schedule an appointment, we send out some general information. We send out the rules because I want someone to come in with a little bit of education to understand that revocable trusts do not protect your assets from the nursing home. And these are the rules for irrevocable trusts. I also ask people to fill out a worksheet that basically gives me an idea when I look at it of who are the players, who do they care about, and what assets are we talking about? Because if I'm looking at the worksheet and they have a house and a little bit of money in the bank and a giant IRA, I'm going to go through all the rules with them when they come in about how IRAs are not considered available once they're in payout. Leave your money out of the trust because you're going to need money to live. And let's put your house in the trust to get the 5 years started. So I look at the worksheet, I meet with the client, and some people don't want their kids to know anything. Some people want their kids involved in the whole process. So I'm okay with it either way.
Sure.
It's up to the client and what they're comfortable with. Some clients want their financial advisor in from day one, and I'm happy to do that too. So we generally meet with clients in person. I can do Zoom. I prefer in person just because then I know who's in the room and who I'm talking to.
Right.
And then we meet. When I send out the drafts to the client, I put explanatory footnotes in them because people aren't going to remember all the rules that I just said. And when they're reading the trust, some of it's technical, and I want them to understand why I wrote it that way. So we send it out with the explanatory footnotes. If they want to talk about it before they come back in, we do that. And that can either be a telephone call or a Zoom. And then we have them come back in to sign it. We go through it again to make sure it has everything in there that they want. And then when we're signing the trust, if we're putting real estate in, I also have them sign the deed at the same time, and we take care of filing that with the county clerk. And then I say, okay, your trust is signed. Remember, you picked these 3 assets to go put into the trust. Go to your financial advisor and get that taken care of.
Sure. So with any successful implementation of a strategy, you have a sound procedure in place and you follow that procedure. Yeah.
That's what we do.
Yeah. Okay, good. And lastly, Tricia, as with any profession, there's always going to be, a few bad apples, so to speak, that upset the apple cart, right? In my line of business, it happens to be, annuities. It seems like annuities are one of the most misused products in the financial world. So can you offer any, general guidance, kind of like a buyer beware kind of advice as far as, for any consumers that might be going in to meet with an estate planning attorney and, to really find out, do I need a trust or not? Or you're going to try to sell me one,
They're going to try and sell you one. So you need to trust your gut. Yeah. And I do that with clients too. So if I meet with someone and my gut is telling me this is not a good relationship, then I will say, thank you for meeting. And we are not a good fit. So for consumers, trust your gut, go in. And if they go in and say, you have a house and a little bit of money in a retirement account, and they're trying to sell you three different trusts, an irrevocable, a revocable, something to get the IRA when you die. You probably don't need all of that. Okay.
Right.
Trust your gut. If you think it's going to be like this giant binder of paper that means nothing, trust your gut. Don't go with it. People don't really interview me anymore, but if you meet with someone and you're like, yeah, the person just wasn't for me, then make an appointment with someone else. What I will tell you is that my colleagues and I who do this regularly and well, we're busy. We're really busy. It's the boomers are at that point, and there are not enough of us. So be patient, because, some of us are scheduling quite a few months out.
Sure.
But you can call a lawyer to talk about a Medicaid trust and get in the same week. They're probably not writing Medicaid trusts with a lot of regularity. So trust your gut.
Great point. Great point. Yeah. Okay. I hear that a lot, and I see it. You see a couple that are state workers, so they have two pensions, and then they're going to have two more guaranteed sources of income, Social Security, and then somebody's trying to sell them two or three annuities. It's like, give me a break. Trust your gut, right?
Trust your gut.
Yeah.
Yep.
So, Tricia, I want to thank you so much for being here, spending the time today with us. This is invaluable information, and I know it's going to help a lot of people in our world. So thank you so much for being here.
Right.
Yeah.
Happy to help.
And lastly, estate planning is such an important part of comprehensive financial planning. It's a component piece, a critical component piece. So anybody listening today, please share this podcast with your friends, family. And, Trish is obviously well-schooled in all of this, and she's experienced. So if anything resonates with you, please reach out to her office and schedule an appointment. But it may take a while.
It will take a while.
Okay.
So I appreciate patience.
Yeah. Thanks again, Trish. I appreciate it.
Thank you.
Okay.
Have a great day.
I always encourage clients to take part in the financial planning process to pursue a confident financial future and, in turn, feel optimistic and proud about their accomplishments. For those who don't have a plan in place, I'm currently offering a free retirement navigator through my website. Please visit www.jgigliello.com to learn more. The Retirement Navigator is a complimentary retirement guide for prospective clients that will demonstrate your personal retirement income projections, tax planning opportunities, and investment optimization. There's no obligation, so please check it out when you can. We always offer complimentary initial consultations as well. If you've diligently saved over the years and have accumulated investment and retirement assets, and you understand that the success of your retirement is too important to be managing yourself, and you value experienced and professional guidance, please reach out to us. Knowing that I've provided education and a plan for my clients has allowed me to turn a personal challenge into a gratifying journey. If you found this helpful, please share this episode, and don't forget to subscribe. If there's a financial planning topic you would like us to address on a future episode of The Retirement Fix, please reach out and let us know. Thanks for listening, and make it a great day. John Gigliello is a registered representative with, and securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. This information is not intended to be a substitute for individual legal advice. Please consult your legal advisor regarding your specific situation. Albany Financial Group and LPL Financial do not provide tax advice or services. Please consult your tax advisor regarding your specific situation. Patricia Shevy and the Shevy Law Firm are not affiliated with or endorsed by LPL Financial and Albany Financial Group.